Onto your markets news now. Asian markets closed mixed today, but Japan's Nikkei share average rose to touch the 39,000 mark for the first time since late July. This was helped by a softer yen and Wall Street's gains at the end of last week. The Nikkei share average rose by 0.14%. The Hang Seng Index fell by 1.65%, while the Shanghai Composite Index declined by 1.1%. Over in the United States, stocks ended August on a firm note. This as investors digested important inflation data closely monitored by the US Fed, namely the Personal Consumption Expenditure Index, which increased by 0.2% on a month-on-month basis and by 2.5% on a year-on-year basis, in line with forecasts. This helped to continue to fuel expectations of a rate cut. The Dow Jones Industrial Average rose by 0.55%. The S&P 500 increased by 1.01%, while the tech-heavy Nasdaq ended the day up 1.13%. The JSE is trading in the red across the board today, with the all-share index falling 0.5%. The rand is trading at around 17.90 against the US dollar, 23.52 vis-a-vis the pound, and 19.81 against the euro. Looking at commodities, gold is trading at $2,498, while platinum is trading at $928 an ounce, and the price of Brent crude oil is trading at $78.80 a barrel. For more on the markets, I'm joined by Gary Boyson. He's a portfolio manager at Rand Swiss. A very good afternoon, Gary. Thanks for joining us. So, being the beginning of a new month, we'll be finding out about the state of nation's manufacturing bases with the release of PMIs. And then on the state side, we had conflicting data come out last week. Inflation numbers there coming in line with expectations, but the growth rate for Q2 higher than expected. So, could that suggest a slower start to interest rate cuts?
Well, I think the start interest rate cuts, I don't think anything's going to derail the cut that we're expecting this month from the Fed. If I look at the Fed funds futures pricing, we're pricing in a 71% chance of a 25 basis point cut, so 0.25%, and around a 29% chance of a 0.5% cut. So the question at the moment, even after the data prints that we've seen, is this cut going to be a regular cut, or are they going to supersize the cut? And if I look at the pricing around rate cuts out over the next 4 meetings, so to the end of January, the probability is 43%. It's the most likely scenario. The base case is for 1.25% to come off the US interest rate across 4 meetings. That means, we're likely going to get 0.25% each time, but one time they're going to cut by 0.5%. So, the data so far, nothing has derailed that. We did get stronger consumer spending data, which prompted a little bit of a rebound in the dollar, late on Friday. But like I said, not enough to derail the cut. And even though we have that non-farm payrolls number coming out on Friday, we're expecting 165,000 new jobs to be added. Even if that is a large miss, I cannot see the Fed not starting interest rate cuts this month. Yeah.
So what about here at home? I suppose a narrative about possible interest rate cuts should also bode quite well for local stocks, especially those that are SA facing. Your expectations there?
Yeah, so we've already seen a huge repricing of South African assets across the equity market as well as the bond market and the local currency. So, like I said, local currency taking a little bit of a hit today, down to, we're trading around 17.90 to the US dollar. But also remember, the US is on a Labor Day weekend, so the US markets won't be opening this afternoon as they take a break. But looking at the SA markets, the bond market has seen huge inflows, from foreigners buying our bonds. That hunt for yield already starting with the anticipation that we're going to get lower rates. SA stocks have seen a huge inflow as well. And part of this is based on optimism around the GNU and a more investor-friendly environment. So I think we are doing the right things. But part of this is also the international landscape and the idea that the hunt for yield is back. And in a falling interest rate environment, emerging economies like South Africa become a very attractive investment destination. We can also see this in the dollar index, which has been hit very hard over the last 2 months, moving from around 106 down to just above 100. A 6% decline in the US dollar against its major trading partners. I mean, that tells a lot of the story of why we're sitting at 17.90 today instead of 18.50.
Let's take a look at a couple of counters, if time allows. Food producer RCL Foods, they released their year-ended June financial results. Group revenue up 6.8% at 26 billion rand, and EBITDA from continuing operations up 36.8% 2%, essentially their profit. Not a bad set of numbers in what most people have really been terming as a challenging environment. But of course, everyone's got to eat, right?
That's true, and they're prepared to pay up to eat as well. So a lot of the rise that we've seen in the headline earnings figure, in the EBITDA figure, is the ability to raise prices as well. Now part of that has been in response to increasing costs, but RCL really has shown the ability to get through price increases, and that's one of the reasons that we're seeing a much better result as well. The company obviously has announced a 35-cent dividend, and also looking at their sugar business. Their sugar business did incredibly well. We've also seen a recovery in service levels across their pet food. So overall, I think a very solid set of results from RCL. And in a down day, we've got the stock up around 2%. So the market definitely liking that. A lot simpler structure now as well, after obviously the unbundling of Rainbow. That now a totally separate business with its own future ahead of it. And of course, they've also managed to sell Vector Logistics. So I think a more streamlined business and rewarding shareholders with that dividend as well.
Sibanye, they released a trading statement indicating to the market that it's likely to report a loss per share for the first half of 2024 between 250.8 cents and 277.2 cents. It's largely citing that poor PGM pricing, and of course it follows those terrible results out of Impala Platinum and Northern Platinum last week. Your thoughts on this particular sector and whether you'd put a cent towards the stock these days?
Yeah, so looking at it, of course, when you have what they call the 4 EPGM basket, so that's palladium, platinum, rhodium, and gold, down 28% in rand terms. Of course, your stock is going to take a hit, and as you said, those headline earnings per share going to be down more than 100% according to the trading statement. Now, you're 100% right. It's very difficult to show positive stock price returns in a falling metal price environment. But remember, there's also the impairments around Sibanye that are significant, at least around the water operation in the US, which are significant. That's also contributing to the fall. They've also had some production issues around seismic activity in Kloof and Driefontein, which has hit production. So I think a difficult period for Sibanye, but would I be allocating to the platinum sector at this stage? I don't think there's a rush, but at the same time, when PGM prices run, and I do think that there's a structural issue in the PGM market with the rise of electric vehicles, but at some point these shares will become a buy. They become so incredibly cheap that even in a negative cycle, they're worth collecting. And I think investors have to remember that quite often markets, you've got to be counter-cyclical, you've got to be contrarian, and generally when the news is the worst is generally the best time to buy securities.
Thank you so much, Gary, for your insights there. Gary Boyson is a portfolio manager at Rand Swiss.